We are very grateful to our sponsor, Baker Botts, for their continued support of our chapter, especially during last year's symposium adjustments. Closest to me is John Platt. John manages a broad transactional practice representing public and private companies and private equity funds in mergers and acquisitions, private equity investments, commercial transactions, and general corporate matters. His practice is focused on the energy, infrastructure, and technology sectors. To the far right is Brendan Quigley. Brendan is a former federal prosecutor in the Southern District of New York and experienced trial attorney. He represents organizations and individuals in government and internal investigations and complex civil litigation, including securities enforcement matters and matters arising under the Anti-Terrorism Act and the False Claims Act. He draws on his decade-plus litigation of litigating complex cases and his judgment as a combat arms officer in the U.S. Marine Corps. And he also served at one point on the Southern District of New York's Terrorism and International Narcotics Unit, gaining significant experience in cross-border and national security-related investigations. And in the middle is Preston, is it Bernheisel, thank you. Preston is the deputy chair of the Dallas Corporate Department. His practice focuses on mergers and acquisitions, joint ventures, capital markets, transactions, security laws in the oil and gas, power, and renewable energy industries. He brings a depth of experience representing issuers and investment banking firms and equity and debt security offerings, including IPOs, other public and private offerings of equity securities, registered and Rule 144A debt offerings, and liability management transactions. Thank you.
Well, it's good to be here with everybody, especially in person with a handful of you here, and to also have those who are joining us virtually. We appreciate the introductions. We're going to be talking about SPACs, special purpose acquisition companies, a term that sometime probably in the last year went from something that you'd heard thrown around by a few different people to eventually maybe, okay, I should Google that and figure out what people are talking about. By now, you probably have gone past the Google stage into hearing about this a few times, but we're going to cover a little bit of the basics, but also get into some of the kind of more recent trends and kind of hot topics that have come up, particularly in the last few months on these. So again, Preston Bernheisel, John Platt, Brendan Quigley. We'll roll into it with John starting with the SPAC IPO.
All right. Yeah, so we're going to go over all stages of the SPAC life cycle, if you will, but starting first with an overview and the IPO process. As Preston said, a SPAC is an acquisition vehicle where a sponsor or a management team raises a blind pool of cash to acquire an operating company. Typically, the sponsor, or oftentimes I should say, a sponsor is a private equity fund or a private capital sponsor. Maybe it's a management team with significant investment experience. And occasionally, and more recently, we've also seen public companies act as sponsors and sponsoring SPACs. From an investor's perspective, a SPAC allows an investor to co-invest publicly side by side with these best-in-class sponsors, as I said. The SPAC investor benefits from downside protections that are built into the SPAC, while the sponsor, if successful, is entitled to entrepreneurial economics through a promote structure or through its investments, typically 10 to 20% interest in the SPAC itself at the IPO stage. So just focusing on the IPO, the IPO of a SPAC is typically structured as a unit offering. The unit consists of one common share and a warrant that's coupled with that common share. Occasionally, the warrant can either be a half or a third, and so you would have to buy more than one unit in order to acquire a full warrant or warrant for a full share. Following the IPO, the SPAC management team, as I mentioned, typically owns 10 to 20% of the post-IPO company, excluding the warrants, and 100% of the proceeds from the SPAC IPO are then placed into a trust account, typically at a large bank, and that trust is used to fund the potential acquisition that the SPAC management team and sponsor pursues. To fund IPO expenses and other costs of the offering, the SPAC sponsor, the management team, will purchase additional units and warrants. Typically, that's 3 to 5% of the offering, depending on the IPO size. And this is often referred to as the at-risk capital. This is the capital that the sponsor puts up, and if they're unsuccessful ultimately that would be potentially what they would have at risk. The initial acquisition, so some things to think about in terms of how the SPAC is structured and what types of investments they would be looking at. Due to NYSE, NASDAQ rules, the SPAC has to, the initial business combination or the acquisition that the SPAC pursues needs to be at least 80% of the value of the SPAC funds and trusts. So the fair market value of the target company needs to be at least 80% of the funds that go into the trust. So that's one condition or limit on the SPAC's ability to pursue transactions. From a practical perspective, and really due to economics and due to what the expectations are in the market, oftentimes the targets, the fair market value of these targets are 3 to 5 times the amount of the actual proceeds in the trust. We'll talk a little bit later about how the delta between the trust account and the actual acquisition is funded. The initial acquisition is also often subject to a shareholder vote, usually requiring at least 50% approval of the public shareholders. And typically the time frame for an IPO, from the IPO stage through the announcement of an acquisition, a shareholder vote, and then the consummation of that acquisition is 18 to 24, or to 2 years, so 18 to 24 months. Here we go. So just a couple of points on why SPACs are becoming so popular. Why are sponsors, investors, why are target businesses interested in a SPAC? First, from the sponsor perspective, a SPAC provides attractively priced capital in the public markets. Through the promote structure that we talked about, it provides significant upside to the sponsor and ability to seek out an investment that's going to result in a significant return for them. It also provides an expanded universe of targets that as there's more target companies that are seeking that, maybe didn't have access to the IPO markets, or there's pent up demand, the SPAC market and SPAC offering allows opportunities to pursue those investments. From an IPO investor's perspective, the built-in warrant that's included in the unit gives an immediate kicker potential above the IPO price. And so there's built-in upside to the investment. There's also the risk mitigation. There's also risk mitigation built in through both the downside protection in the trust account, as well as an ability to decouple the common share from the unit following the IPO. And so you could actually recoup your investment potentially by selling the common share, but holding onto the warrant and the upside of the potential Dspac transaction. Sponsors are also highly incentivized to pursue an acquisition. And so this again goes to the built-in upside that's associated with the warrant that's included in the unit in the SPAC IPO. From a target owner's perspective, why would a Dspac transaction, or why would an acquisition or a potential transaction with a SPAC be attractive? And one reason is the access to capital to fund growth, further M&A, and potentially receive proceeds that are larger than what would be accessible through a traditional IPO process. It also can be an expedited process, typically a transaction through a SPAC, if that's the route to a public markets, can be done in a shorter time period than a traditional IPO. A transaction with a SPAC also, from a target perspective, provides better pricing certainty in that you're negotiating an M&A transaction as opposed to going out and marketing an IPO that's subject to the pricing, at the time of the pricing of the IPO. It also allows flexibility in how that is priced, because you can negotiate the terms of the acquisition agreement, potentially resulting in an earnout payment or varying forms of consideration that allows flexibility.
All right, so thanks, John. I'm going to talk a little bit about just kind of an illustrative timeline of a SPAC IPO. Now, again, maybe just in a nutshell, pointing out that these are so wildly popular because of, like John said, how little is actually at risk in terms of the few percent that the sponsors put up, where it makes sense for them to have this big upside put up just a little bit of their own cash in, as far as at-risk amounts, have that big upside, and then have investors have the upside as well with very little risk on them as well, because they can either redeem, when it comes time to vote on what we call the Dspac, which is just the transaction that you're applying the IPO funds to acquire the company. They can redeem their unit, their common unit, but hold on to their warrant and still get the upside. So you could vote against the deal, or I'm sorry, they wouldn't vote against the deal. They could redeem and say they're out, still vote for the deal because you want the deal to go through so that your warrant still stays, beneficial to you. And therefore you now have a opportunity to have ownership in a company post-acquisition, even when you got your initial investment money back. And so you can understand a little bit why it's so popular in doing this. And the time frame is another thing as to why these are so popular. The overall time frame to go public is much shorter than if you were an operating company that was considering your own IPO. So you take this on this slide, preparation. You've got a couple weeks. Now, the first point is very important, and that is there's absolutely no engagement in discussions with potential targets. In fact, when you file your IPO, you are making a statement that you don't even have a potential target in mind. That's an SEC requirement, an SEC rule as part of that IPO, that this is truly, your blank check, creating this company, have no target in mind. And so you prepare a registration statement, which is actually quite simple, especially now that so many have been done, because you don't have a real operating company to describe. Usually what goes into a longer registration statement in a typical IPO is you're describing the ins and outs of the business, all their material agreements, their customers, what their financials have been over the past, 3 years. You have all that information about a regular operating company going public, whereas for a SPAC, there's very little of that. So it all comes together very quickly. You prepare a roadshow, you engage auditor, financial consultant, just like you would in a regular IPO. The key here, though, is in the middle, determine management team and your independent directors. I mean, your management team, along with the identity of your sponsor, is essentially what you're IPOing. That is what investors are buying into, is I want to invest in that management team and the acquisition opportunities that team is going to go out and look for post IPO, and that's where I want to put my money. So that's the real key of the overall IPO. Otherwise, it looks very similar structure-wise and task items in terms of a regular IPO. You're engaging underwriters, investment banks that are going to have their names on the cover of your prospectus and be out there selling the deal to the public. You're going to get your stock exchange listing, whether NASDAQ or NYSE. Legal and financial diligence, again, you're going to do it, but it's at a whole lot lower level in terms of the time it takes and effort than if you're a regular company that was being diligenced both by issuers counsel to make disclosures and by underwriters counsel to confirm the underwriters and the bank's participation in the offering and the disclosure that's going to be made with respect to it. So all that can be done in a couple weeks, whereas, if you're talking about a operating company IPO, more typical IPO, you're looking at least, a couple months to longer. Then you have the actual IPO process, and this is about, at least 8 weeks. And this is where you're figuring out the economics and the deal terms of what the founder or the sponsor is going to do in terms of its shares, whether at the front it's going to put in its own private placement of warrants to create additional funds. Also, a sponsor FPA or a forward purchase agreement, that's basically the sponsor funding up front or basically agreeing to fund up front what is going to be contributed in connection with that Dspac transaction, the actual acquisition. And so that would support that. A bunch of acronyms we have in our slides. IBC is the initial business combination, or the Dspac, the actual acquisition. And so you come up with those financial terms and what the actual, economics are, what's going to be contributed. You file your registration statement. You have the SEC review, which is its normal, typical 30-day review. They get comments, then another couple weeks, you make your second filing, get comments, and eventually go effective. If, as companies are allowed to do these days, you're allowed to make a confidential submission first, where it's not a public filing that other people have access to. In that case, you have to wait 15 days until you have made a public filing before you can go on your roadshow and go effective. Again, units become trading, start trading. The IPO proceeds, like John said, all go into a trust account. So some kind of like escrow trust account where the funds sit there that the sponsor can't touch, and it sits there until they identify a target. You go through the approval, shareholder approval process with respect to that target, and we'll get into that process later. But that's the other thing that people kind of have that comfort that the funds are sitting there in a trust and untouched so that they can be redeemed if necessary. The underwriters do collect a partial fee, and then you complete the IPO process, you close, the funds are in the trust account. Now you can go out and start looking at potential acquisition targets. Maybe you start having discussions, start developing letters of intent. You figure out what the another acronym, PIPE, which is a private investment in a public entity. You're figuring out what investors may want to invest in your now public entity in order to go out and make an acquisition. And we'll get into, again, that in connection with the Dspac transactions. Some of these other things on this timeline are also just mailing the proxy statement and the registration statement that we'll talk about in connection with the Dspac, because when you're making that acquisition, you're generally doing it with the public shares that you have. And for a public company to acquire a company through its own shares instead of just paying cash, you've got to file another registration statement with the SEC, this time generally on S4, to register the issuance of those shares to the holders, the equity holders of the company that you're acquiring. Another SEC review process, you go through that until ultimately you can close. And just to wrap up the IPO conversation, at that point, the underwriters collect some deferred compensation. So they get an initial partial fee, but then on the back end, because ultimately this is all with the goal to making the actual acquisition, they get another 2 to 3.5% of the IPO proceeds as payment. And then you work out the post-acquisition capitalization. You have whatever the sponsor was negotiated up front. There might be some anti-dilution that is waived in connection with that acquisition. And then at that point, your warrants are exercisable. People can kind of kick into that upside that John talked about before. Some recent updates that we'll talk about. A lot happening in the past year or so. So went from 2020 where just in 2020 alone, SPACs were about 53% of all IPOs. A big reason for that was with the impact of COVID and that kind of shutting down a lot of deals and business for a significant period of time. You had a lot of private equity investors were now sitting on cash. They essentially had this dry powder that was ready to invest. Well, what better way to invest it than a structure where it's a relatively safe investment into a SPAC that you still have the opportunity to get the upside on the acquisition down the road instead of in the middle of COVID trying to create an acquisition right then. And so you had a lot of private equity funds that went into the SPAC market, software, pharmaceuticals, energy, biotech, all kinds of different industries. Goes without saying, an all-time high, over 3 times, 2019. And then here we are in 2021, and already in the first quarter of 2021, we've exceeded 2020. And so you can see how this is just this major snowball just rolling now. We'll get into where that's paused a little bit as Brendan talks a little about some of the SEC commentary and investigations that have happened recently that he'll talk about that might have slowed that down a bit, but certainly not shut anything down. again, in 2021, we've seen record proceeds. We've seen the record size of a SPAC in terms of the Pershing Square with $4 billion price or total proceeds, whereas the average SPAC size in 2021 is $326.5 million. Initially, there had been a trend where these were around that 300 million, but we are starting to see more and more what we're calling whale hunters in terms of going after these monster sizes with Grab at 40 billion, real-time electronic payments 4 billion, DraftKings was 3.3 billion. These bigger size IPO SPACs. More and more credible sponsors are getting in the game. Basically, any private equity group that doesn't have a SPAC arm at this point is behind the times and trying to catch up, where most of those sponsors are leading it. And as John said, even existing public corporations are getting into the SPAC game. What's really been interesting is the change in the deal speed. We talked about the timeline. The average days of the IPO, from IPO pricing all the way until the Dspac, the closing of the actual acquisition, has gone from 433 days to 28 in 2018 to 133 in 2020. So 300 days shaved off of that average time. You can just see how more and more people are getting used to the structure, the speed at which these happen, and we expect that to continue to speed up. What you are starting to see because of the popularity is a compression of the economics, where the you go from 88% of the founder shares, 82% of founder warrants being now retained, with remainder being forfeited, transferred to PIPE investors, where sponsors are giving up some of their economics to make these happen. Again, since there are so many happening, they need to attract investors, both on the public side and the PIPE investors, to come to their particular SPAC. Turn it over to Brandon for more recent markets, but more on the SEC investigation side.
Sure. So over the last 4 or 5 months, the SEC, after not having a lot to say about this SPAC surge over the last year or two, has come out with a number of pronouncements. Interestingly, not much formal rulemaking, although that may come later. But there have been a number of announcements, and some of it, like for example, the first two things on this slide are more kind of retail investor focused, general guidance. That first SPACs, what you need to know, came out in December. It's kind of like a SPACs 101, celebrity involvement with SPACs. As been a number of celebrities who've been SPAC sponsors and things like that. And obviously the point of that was like, just because, some actor is running a SPAC doesn't mean it's a good investment. Kind of common sense, again, more retail investor focused. Then there have been some other more a little bit in the weeds pronouncements. And these are really focused, I would say, on 3 particular areas. Number one is conflicts. The second is projections. So what can the SPAC say in its filings, and what should it be saying about the future operations of the combined company? And then the third is really issues involving accounting and internal controls, both for the SPAC itself and potential SPAC targets. So, and this division of corporate finance, the focus on conflicts, the second row there, back in December, the Division of Corporate Finance came out with a CF disclosure guidance. And that's really like a checklist of things that SPACs should consider disclosing, again, with a particular focus on conflicts. And what do I mean by conflicts? Well, for example, how do the incentives of the SPAC sponsor potentially to close a de-SPAC transaction match up with the incentives or the risks to SPAC investors? Do the SPAC sponsors have any? Obviously, we said they can't have identified a target company at the time of the IPO, but do they have a relationship with the company that ultimately becomes the target company? Do the SPAC sponsors or the SPAC board of directors have fiduciary responsibilities to other companies, either because they serve on other boards or because of other employment roles that they have? Those are all things that CorpFin put out in that December 2020 guidance. Now, it's good that it's a, if you're a SPAC sponsor, a SPAC director, it's a good, certainly a very helpful checklist. As a litigator and primarily a defense side litigator, I will tell you it's also a checklist for the plaintiff's bar to determine, what types of things they should be citing in a complaint. Projections, we talk, I'll circle on accounting first. We'll talk more about this in a little bit, but within the last, I guess on April 12th, that bottom bullet there that we'll talk about in more detail in another slide or two, discussion from the SEC about proper accounting for those warrants, right? The warrants that are issued in connection with the SPAC IPO, how those are accounted for. And that got a lot of press. And some people have said it's responsible for a little bit of a slowdown in the SPAC market in the last few weeks. And then discussion of securities law liability. We'll talk about this more in a couple of slides again. But director of CorpFin came out with a discussion of our SPACs. Really, he said he set up a little bit of a straw man, I think, but he said it's been commonly discussed by market commentators that SPACs are less risky from a securities law liability perspective than a traditional IPO, and he pointed out some ways that might not be true. Again, focusing on conflicts, focusing on the availability of the safe harbor provision of the Private Securities Litigation Reform Act in connection with the Dspac. And, not surprisingly, with all these announcements by the SEC over the last 4 months, it's been publicly reported that there are a number of SEC inquiries into SPACs and into incentives of underwriters and other folks involved with SPACs. So moving ahead, just keep this moving along here. This warrant issue that came out on April 12th, again, this has gotten a lot of press. As we talked about earlier, in connection with the SPAC IPO, in addition to equity shares in the SPAC issues warrants. And typically, these warrants have been accounted for as equity instruments, not liabilities. And in this April 12th announcement, the acting chief accountant of the SEC pointed out that equity treatment requires a warrant to be indexed to the stock, and there can't be other variables like the accounting for the warrant can't depend on who holds the warrant, right? There's also an issue if there's a tender offer, depending on how the warrant is treated in connection with a tender offer, right? Can you receive cash for that, or do you receive shares, right? Depending on depending on the SPAC, some of those may be improperly classified as equity instruments and should really be classified as liabilities. I'm not going to go through all the technical accounting here, but it's on the slide. It's been kind of widely reported that since this announcement about 3 weeks ago, the SEC has been refusing the effectiveness of SPAC registration statements until this accounting issue is resolved. It's important to note that the mere accounting treatment of SPAC issued warrants is probably not material under securities laws, but this does apply to more than just one or two SPACs. And it number one, may account for a little bit of a slowdown in the SPAC market, at least in the near term, while the issue gets resolved. And moreover, I think signals that the SEC is closely watching the SPAC market and is making sure that it's not, a runaway market, and that careful consideration is being given to accounting and disclosure issues. So that post-IPO SPAC, I think so what are some litigation and regulatory issues? Again, kind of stepping back a little bit here from the IPO to the Dspac transaction. So, typically 18 to 24-month process, 18 to 24-month window from the IPO to the Dspac. As we saw in actuality, that those deals are closing, those Dspacs are coming to fruition more quickly in the last year or so. As Preston pointed out, in the IPO, in the SPAC's IPO, it cannot have identified a target. There's an SEC regulations on that, and then most SPAC registration statements, in fact, all the ones that I recall seeing have a essentially a semi-boilerplate disclosure that we have not identified a target, nor do we have a target in mind. The charter and the bylaws should contain for the SPAC, and this is more geared to SPAC sponsors, but should contain appropriate exculpatory provisions and form selection provisions. There's favorable case law a couple years ago outside the SPAC context in Delaware, supporting federal form selection provision for claims under the Securities Act of 1933. That should be included in under the Exchange Act of 1934. By statute, there's exclusive jurisdiction in the federal courts. What are the issues so post-IPO, the SPAC's out there, it's looking for a target. What are some litigation enforcement type issues to be wary of? And I think the number one is that the SPAC, even though it has no operations really at that point, it's still a public company, right? It's gone through an IPO. It has, the directors have fiduciary duties. It's subject to SEC reporting requirements, and it's really important that the SPAC observe, corporate formalities and good corporate governance. That's both the right thing to do, but it will also help prevent allegations down the line that the SPAC was, there were conflicts and things like that. And also, even looking way ahead to the Dspac, you want to maintain good kind of corporate governance, corporate formalities with respect to diligence regarding potential targets. All right. So that when you have board meetings and things like that to discuss potential targets, there should be materials and diligence materials given to the directors in advance to discuss those targets. And that will help guard against a claim down the line that the directors failed in their duty of care to diligence the target appropriately. Again, we talked about some of this stuff already, but at all stages of the transaction, careful attention must be paid to conflicts of interest, including those which may give any actor, but not limited to the SPAC sponsors and directors and officers, an incentive to get a deal done with a target. And I think one thing that plaintiffs bar, I think will seize on and has seized on to some extent already, is looking at deals that close, towards the end of that 18 to 24 month litigation window, and citing that as evidence of either a conflict or a breach of the duty of loyalty by the directors, or in the context of a federal securities claim under the 34 Act as evidence of scienter, or bad intent, right? They just wanted to get a deal done. They weren't really paying attention to, they weren't really acting in the best interest of the shareholders. A lot of suits that have been filed after the IPO, but before the Dspac, have been merger objection suits that have been mooted by additional disclosures. So there's some relationship with something that wasn't disclosed. The SPAC then discloses it, and the case settles for kind of a nominal mootness fee. There has been at least one recently. I saw a 10b5 case filed against a SPAC sponsor, and also the target for statements that after it was announced, or at least rumored, that the SPAC was going to acquire this target, that the CEO of the target made about the target's future business prospects, which turned out not to be accurate. The key thing there is, just 10b5, written rule 10b doesn't have to be an SEC filing to be actionable, right? It can be any false statement made in connection with the purchase or sale of a security. So in this case, the allegations relate to, I think, statements made on CNBC or Fox News or Fox Business that were, clearly plaintiffs allege false. So that takes us, I think, up to the Dspac merger.
Yeah. So I recognize we're the only thing standing between you guys and happy hour, so we'll keep going here as we're at the end of the day, I know. But the Dspac process. So maybe just I know we've used this term Dspac throughout the presentation, just to be clear. So we start with the IPO process. Once you complete the IPO, you're a SPAC, right? You're a special purpose acquisition company. And then the goal is to find a business combination and complete an acquisition, i.e. a Dspac transaction, so that you're following the business combination, you're no longer a SPAC. Typically, as we've said a couple times, the SPAC, the terms of the SPAC in its S1 provide that for a term of 18 to 24 months to pursue and find and identify and close that transaction. One thing to note is that the NASDAQ and NYSE, the stock exchange, allow for up to 36 months for a SPAC to find an initial business combination. And so there is a potential to extend that period, although oftentimes that would require some sort of shareholder approval in order to do that. But occasionally that does occur. The business combination itself can be structured in a number of ways in terms of the consideration. There can be there's often cash out deals that involve just significant cash going to the target equity holders, or it can be perhaps more common recently is the reverse IPO deals where it's mostly share consideration that goes to the targets and where the targets are looking to essentially take advantage of a kind of fast track IPO process that the SPAC deal enables them to do. Again, target enterprise value must be at least 80% of the trust account value. So that's something to keep in mind. In particular, where, as I mentioned, the size of these transactions are becoming very large. And so where you have a reverse merger, you're going to have share issuances, and that could result in issuances of shares above the 20% threshold, again, triggering a shareholder vote under stock exchange rules. Just some things to consider in terms of how from the target's perspective, how they're going to be looking at the Dspac transaction and kind of reasons for undergoing the process. Again, first, it allows them to streamline financings, potentially combining if they're these are large private companies typically that are the targets, and so they're going to combine kind of a late stage financing with an IPO. So they get access to the capital markets, allows for additional, funding possibilities to help them continue with their growth. It also oftentimes will allow the private company or the target to raise more capital than they would in just a traditional IPO. Again, this has to do in part with the way the SPACs are structured with the debt financings, the PIPE financings, as well as just additional liquidity through the capital markets. And then, finally, the SPACs may be able to offer higher valuations. Again, because the SPACs are highly incentivized to do a deal. They've got the dry powder through the trust account to be able to provide cash proceeds. But that will be tested through the PIPE market, especially as there are more and more SPACs that are out there looking for transactions. The PIPE market has become, the market for these PIPE investors has become more constrained, and they are more likely to take a strained view at the deal or a close eye and evaluate the transaction with a close eye before agreeing to provide that additional PIPE financing. From the SPAC investor or the public shareholder's perspective, a couple things to keep in mind is that most of these transactions will be structured such that there's a minimum cash or a maximum redemption and closing condition. So if there's a certain specified number of shareholders that elect to redeem their shares rather than participate in the initial business combination, then potentially the deal would not close. That would be a closing condition that would not be satisfied. And this is to make sure that the SPAC has enough or has sufficient cash to close, because obviously they're going into, they've got a kind of a flow of funds, which we'll go through in a minute, in terms of the consideration sources. And one of those is obviously the cash from the trust account. And if there's too many redemptions, then there's not sufficient cash to close the deal. To this point, I expect shareholders typically have 2 days before. They have up to 2 days prior to the shareholder vote to elect to redeem their shares. All right. So just again, thinking about the purpose of this slide is really going into the M&A document, what the merger agreement or the other transaction document that will serve as the governing document for the Dspac transaction. The type of consideration, as we talked about, can be a combination of cash and shares. Occasionally, it could be all cash, depending on how the transaction is structured. We could also have a portion of the consideration being structured as an earnout, and those earnouts are typically tied to the trading price on a post-closing basis. As I mentioned earlier, this provides an interesting component or kind of a key feature for a SPAC Dspac transaction from a target's perspective versus an IPO, in that it allows some flexibility in how the pricing, the ultimate value to the equity holders of the target. The transaction, the mechanics for determining the transaction consideration, I should say, it varies across deals. It's kind of, you should think of these transactions, typically they're kind of a hybrid between a private company M&A deal and what you would see in a public company M&A deal. There's common features that are typical in public M&A that are also typical in these SPAC deals, including the fact that there's limited recourse typically. So there's, oftentimes there'll be rep and warranty insurance to kind of bridge the gap there. And then in terms of just valuating or the valuations in the transactions, oftentimes it'll be a kind of a private company style, cash-free, debt-free enterprise value, although occasionally they use different valuation metrics based on equity value, and sometimes that's a fixed equity value. Again, one of the important components is that the fair market value or the value of the target company has to be at least 80% of the trust account. That's a key condition or requirement for the Dspac transaction. Although, as I said, in practice, we're certainly seeing that's the target is actually much higher than that trust account. Typically 3 to 5%, 3 to 500%. All right, so I was talking about a minute ago the sources of available cash, or the kind of available funds for purposes of the financing the deal. One is, of course, rollover equity. This is just where the target equity holders are going to receive shares in the combined company. The trust account provides a significant portion of the cash proceeds. And this is obviously the proceeds that were raised in the initial IPO that are in the trust account for purposes of consummating the initial business combination. Occasionally, SPACs will enter into debt financing or commitment letters. Those are usually entered into at signing of the Dspac transaction, and often you'll see debt commitments when there is a significant cash out component. So this is basically in lieu of the rollover equity, the target equity holders are cashing out in this type of a transaction. And then, of course, a very common component to bridge the gap between the trust account and the fair market value, or what the consideration is in the transaction, is the PIPE financing. And this is where the SPAC is going to raise money through the issuance of additional shares in a private transaction at the closing of the Dspac transaction. As I said, the PIPE market has become rather constrained, as there are a number of SPACs out there looking for deals and Dspac transactions being consummated. And so, I think this may be one component that lends itself to the SPAC market kind of not going away, certainly, but cooling off, is some constraints in the PIPE financing market. In fact, what we've been seeing recently is that sponsors, as they're getting ready to raise an IPO for a SPAC, they may be lining up PIPE investors to co-invest along with them at the sponsor stage, so that they have investors ready for the PIPE stage as well on the Dspac transaction.
All right, so let's talk briefly about just kind of the timeline of one of these Dspac transactions. Pre-announcement, again, you close the IPO, and iterating one more time that no dialogue between the SPAC and the target before the IPO closes. But then after the IPO closes, you can be out there hunting for your deal. You find a target, you enter into a letter of intent. A lot of times it has some exclusivity feature where that locks the target up from other potential buyers. Sometimes it also locks up the SPAC in terms of their exclusivity. All of that is negotiated, and the whole transaction, John talked about the financing sources. So the whole transaction, the acquisition, is wrapped up in your pipe investors, your debt commitment. All of that needs to be kind of coordinated. And so you have all these constituents that are going to be weighing in on, even at your LOI stage, potentially your potential acquisition. And so you get that LOI and you start marketing to your pipe investors if you haven't already talked to them before that. And again, at that point, you are a public company. So you are cognizant of Reg FD rules. You're getting confidentiality agreements, wall crossing, like John was talking about, in terms of getting these investors inside the know of what you're looking at in order to potentially fund it. And so that may, if you're going to have that pipe, you might need a little bit longer of exclusivity period so you can get those pipe investors up to speed and supportive of your acquisition. Otherwise, you're signing the agreement. Again, you're a public company, so you got to file your 8K, publicly announce the transaction. It couldn't be more material of a transaction because it is the reason for your existence, right? So you file the 8K and other deal related materials. If you had wall crossing with pipe investors that maybe locked them up until you made this announcement, you might do what's called a blowout, where you, in addition to the material terms that everyone would otherwise want to know, you disclose some other terms that otherwise prohibited the pipe investors or other debt commitments investors from trading on securities. And so you blow it out for MNPI or purposes of allowing that information to be traded on. Typically, you will, the proxy registration statement will be filed for shareholder approval. Again, you're registering securities of a public company to acquire the company, and so the target. And so you're going to file that registration statement on S4, go through a round of SEC comments, possibly. Sometimes they may pass on the commenting period. And then you go to your mailing process and holding your shareholder vote. All in all, you close a few days after your shareholder vote. As we talked about before, there's incentive for those shareholders to approve the transaction, because even if they just want their money back, they can always redeem and still vote for the transaction and have that warrant that allows them to stay invested in the potential upside from that transaction that they already were redeemed from. So all in all, the Dspac process is around 3 months from the LOI to closing. And again, a lot of that depends on your pipe investors and debt and other kind of sources of financing. We'll hit some litigation enforcement issues on the Dspac transaction.
Thanks, Preston. Yeah, I think it's generally thought by most folks that there's going to be large-scale litigation or investigations coming out of the SPAC surge. It'll be they will be brought after Dspacs, and I think the common fact pattern will be that there's a Dspac and the combined company does not perform as expected, and then either the private plaintiffs, the SEC, or the DOJ will be looking at those disclosures made around the time of the Dspac to see what, if anything, was not disclosed or what was falsely stated. And there are a number of theories of liability under the federal securities laws that could be asserted in connection with the Dspac transaction. Obviously, as we've mentioned, the Dspac involves a proxy solicitation under Section 14A of the Exchange Act. There's a cause of action, both a SEC cause of action and an implied private right of action for false or misleading statements made in connection with a proxy solicitation. Most courts have held that the scienter element, right? There is no scienter element, right? It's the defendant knew or should have known, essentially a negligence standard, that the proxy statement contained false statements. It's a limited. The plaintiffs, potential plaintiffs, in addition to the SEC, are limited to shareholders who are entitled to vote on the proxy. As we mentioned before, Section 10B of the Exchange Act, kind of the workhorse of the securities enforcement, securities litigation side of the house. Does have a scienter requirement, but applies to a broad range of statements, including statements made, at road shows, on TV, on podcasts, whatever. I mean, Elon Musk was charged for under 10B for a statement he made on his Twitter account, so it applies to anything really. Also, to the extent that not on the slide, but to the extent that registration statements are filed in connection with the Dspac, Section 11 of the Securities Act provides a cause of action there, and again, does not have any scienter requirement, at least for the issuer. We've also seen a number of cases brought already using state law theories of liability, breach of fiduciary duty. Again, these have largely been based on conflicts, mostly in New York and Delaware. Sometimes in New York applying Delaware law, and there the plaintiffs have really, again, pointed out the conflicts or alleged conflicts of the SPAC sponsors for instance, in trying to get a deal done so that an entire fairness standard applies to board action. Typically, the business judgment rule would obviously apply, but in some cases involving conflicts, a much higher entire fairness standard will apply to a court's assessment of that transaction. Another thing that's not on here, but we've alluded to it, so I'll just reach out to it. I would expect to see, particularly from a government enforcement angle, some insider trading investigations around the time of the Dspac. There is, as Preston pointed out, different constituencies. There is material non-public information being shared with some of them, but not others. There are obviously ways to control for that, as we've alluded to, in terms of lockups, in terms of disclosures. But I do think that you're going to see, some government investigations around that. So, what are some best practices that SPACs, SPAC targets, SPACs, boards of directors of SPACs can follow? And obviously, disclosure is the touchstone of the federal securities laws everywhere, and it's the touchstone of the federal securities laws here. And particularly with respect to forward-looking statements, as I mentioned, the head of CorpFin at the SEC had suggested that the safe harbor in the PLSRA did not apply to statements made in connection with the Dspac. But there are other, number one, that never applies when the SEC brings a case. And there are other statements, there are other doctrines that can insulate forward-looking statements from liability. In the main one being the judicially created bespeaks caution doctrine. But the key thing is that statements have to be identified as forward-looking, and they have to be accompanied by meaningful, non-boilerplate cautionary language. So if there are things that may cause a projection to differ from what you think it's going to be, those have to be meaningfully disclosed. And obviously that's going to vary on the facts and circumstances of each case. But it is important to have, again, that for projections and SPACs are all about, I think even more so than a lot of companies that go public through an IPO, those projections are an important part of the financial statements. How's this combined company going to work in the future? This company, which heretofore has not existed, certainly as a public company, and how's that going to perform in the future? I think another thing I talked about earlier about the SEC's focus on accounting and internal controls. Another thing that's come up is for the SPAC target needs to be prepared to meet the accounting and internal controls and governance requirements of a publicly traded company. And the ramp from private company to public company is a lot shorter in the SPAC context than it might be in like the traditional IPO context. So it's important both for the target and for the SPAC sponsors to ensure and recognize that once that company goes public, it's going to be a public company subject to exchange requirements, subject to SEC requirements. It's going to have the infrastructure to meet that. Is that a question?
There are two questions from folks who are participating virtually. If we could make sure we can slot those in.
Yep.
Is this a good time maybe just to jump in?
Yeah.
The first question is from Michelle Mazzini. And her question is, have you seen any transactions where instead of a IPO, a group takes a clean public shell company where the group has 80 to 90% of the stock and does a secondary offering to get the funding?
Secondary offering. Yeah, I mean, there've been kind of the transactions even outside of the SPAC world of, kind of the reverse IPO, which is what that sounds a little bit like, where you take a existing public company that may have had operations but sells them off, but still has a public share in which you can, then go out and acquire another company. And so that's a similar approach that the SPAC kind of creates a version of to set up a blank check company. And in terms of the funding, then yeah, you're raising additional funds through a secondary offering in connection with that acquisition. So it would, technically SPAC rules, but it's a similar concept of taking pre-existing public company and acquiring a different
Assuming you
business.
have enough authorized shares, you can probably do
Yeah.
a secondary offer, right?
Yeah.
So here's the second question. Is from Paul Talbot. It says, does the 8K announcing a Dspac include full S1 disclosure, or is that deferred to the proxy statement and or S4?
You would have that in the S4. It's similar to take SPACs aside, any, public company has a material acquisition that it's going to have some combination or is going to be filing an S4. You're filing your 8K that discloses the entry into that agreement, but then the projections about the transaction, the disclosure about the history and the background of the merger, all that will come in the S4 in terms of that style registration statement. You also have, financial statement obligations, but even in the regular acquisition world, those are triggered on a delayed basis where you don't have to actually file those, upon signing.
That's right. The Super 8K is going to have a lot of information. It's going to look very much like an S4 and an S1 and regarding the transaction. But I think that's right, that in the S4 where you're seeking the shareholders either consent or they're waiving their redemption right, that's going to be the more fulsome look like the S1.
Yeah. Well, those are good questions. We'll go ahead and we had a few slides in the back about public company SPAC sponsorship, and just one plug that Baker Botts did happen to represent Liberty Media in its SPAC sponsorship, and that was the first of that kind. But a lot of detail there that, on the slides that you have, that you can kind of flip through. I would say that the difference, of course, you have an existing public company that has to navigate its own disclosure rules as it thinks about being a sponsor for maybe a new line of business or a new, company within a conglomerate or, whatever it is. So you got to work through a lot of existing public company issues. And then a lot of it is going to be related party affiliate issues in terms of your management. Do you have the same officers up at public company now serving on the, on the board or as officers of your SPAC company, and how the relationship and approvals with respect to anything that you do with that SPAC kind of have to go through conflicts, audit committee approvals, things like that. And so a lot of more, things to think through and complicating factors when you're an existing public company thinking about doing that, but it happens, and it's a good opportunity so it's not just a private equity world thing, but something for even existing public companies to think about as a possibility.
Especially very acquisitive public companies that are out doing deals all the time, and they have a kind of proprietary deal list or deal opportunities, and maybe that one or more of those could ultimately turn into an opportunity for a SPAC. As Preston was saying, a lot of considerations that goes into that, and conflicts and things like that, and including, when would an acquisition that would be appropriate for a public company SPAC be appropriate for the SPAC versus the actual public company. There's need to set up all sorts of processes and procedures for that. But that's certainly something that we're seeing kind of an uptick in the public companies that are willing to sponsor SPACs. The only other thing one thing I wanted to hit on as well from a corporate perspective, and thinking about the Dspac transaction and the targets, the potential targets, the targets need to be public company ready generally, right? Because it's basically a backdoor IPO, or not backdoor is probably the wrong word, but a streamlined IPO. And following the consummation of the transaction, you're going to be subject to all the public company requirements. And so, in thinking about potential targets, public companies that have maybe non-core business lines, or various other business lines that they may be looking to sell or spin off, those business lines could be good target opportunities potentially for a Dspac. Just something to keep in mind as you're evaluating your business line.
Yeah, that's a good point. With that, we'll wrap up. Thanks everybody, and let everybody go to happy hour, or if you're at home, whatever else you need to do. So, thank you.